Gold just fell over 20% from its all-time high. Silver is still up over 100% this year. And two of the biggest chart traders in this space just told their audiences the same thing this week. The next move could go either way, but the reason why is bigger than any single chart. Here's exactly what I'm breaking down today. 1. What the actual charts are saying right now, straight from this week's technical calls. 2. The real reason gold and silver keep getting pulled in two directions at once. And it isn't the Fed. 3. What this means for you, whether you're already holding metals or you're standing on the sidelines wondering if you missed it. Let's get into it. If you bought gold in January at $5,300, you're underwater right now. And that matters more than people admit. Gold hit an all-time high above $5,300 an ounce in January. By July, it had dropped to a 7-month low near $3,944, a correction of more than 20%. It's since bounced back to around $4,950, but two of the most watched technical traders in this space are both flagging the same risk this week. Trader Nick, in a video posted July 3rd, warned buyers to be cautious. The bounce is losing momentum, and a break of key support could open the door to another leg down. Gareth Soloway, just 2 days ago, described gold and silver as coiling toward a decision inside a wedge pattern, with no confirmed breakout direction yet. Soloway's been tracking this since April, first flagging $4,300, then $3,900, and floating the idea that $3,500 could be the real washout low before any lasting bottom forms. So here's the point. This isn't a market that's broken. It's a market catching its breath. A 20% pullback after the fastest run to an all-time high in over a decade isn't a collapse. It's honestly pretty normal. But if you're trading week to week, respect the warning both of these traders are giving. Don't chase green candles assuming the bottom is already in, because two completely separate technical frameworks are both saying the same thing right now. We're probably not there yet. While gold is consolidating, silver just did something it hasn't done in years. It started outperforming, and hard. Silver is holding around $61 an ounce. The gold to silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, just dropped to 67, meaning silver is running hotter than gold by more than 1.5 to 1. Why? Silver's been in a structural supply deficit for 5 straight years running. More than half of all silver demand now comes from industrial use, solar panels, electric vehicles, electronics. And that demand doesn't care what the Fed decides in September. Analysts at goldsilver.com are calling for silver above $100 in 2026 if the deficit keeps deepening the way it has. This is the part people miss. Silver isn't just riding gold's coattails anymore. It's got its own engine, real industrial demand, plus a supply gap that isn't closing anytime soon. And that gold-silver ratio, sitting well above its long-term historical average, is exactly why a lot of analysts think silver is still the more undervalued of the two metals, even after this year's run. Everyone's watching the Fed for the next rate decision. They're watching the wrong thing. The U.S. national debt just crossed $39 trillion. Net interest payments alone now eat up nearly 14% of the entire federal budget, more than defense spending. The deficit is running above 7.9% of GDP, and there's no political will in Washington from either party to close that gap. Sprot's market strategist Paul Wong put it plainly. In an economy this leveraged, the only real mechanism left is currency debasement, devaluing the dollar and the treasury bonds denominated in it, because you simply can't tax or grow your way out of a hole this size. That's why central banks bought 474 tons of gold in the first quarter of 2026 alone, the second highest quarterly total on record. China's central bank just logged its 18th straight month of gold purchases. These are institutions with the longest time horizon on the planet, and they're quietly walking away from the dollar as the default safe asset. Rate decisions move gold day to day. Debt levels move gold decade to decade. That's the trade everyone's actually watching, whether they say it out loud or not. And it's worth saying, this isn't a fringe theory anymore. It's showing up directly in central bank balance sheets, not just in opinion pieces. If the price action this week felt chaotic, that's because it is. And that chaos is actually the system doing exactly what it's supposed to do. June's jobs report came in weak. Private payrolls added just 98,000 tons versus forecasts near 118,000. That single data point caused rate hike odds to collapse from nearly 70% down to a coin flip in about 48 hours. The 10-year Treasury yield swung sharply, rebounding to 4.48% off a 7-week low. Every time hike odds spike, gold gets punished because real yields, the return after inflation, are the one thing gold actually prices. Every time those odds collapse, like they just did, gold and silver both surge. Layer on top of that the tension in the Strait of Hormuz, tankers getting struck, an interim peace deal hanging by a thread, and you've got a market reacting to war headlines and labor data in the same week. This isn't randomness. It's the real yield mechanism firing in real time. Once you see it, the "why did gold move today" question basically answers itself every single time. Watch the jobs data, watch the hike odds, watch the yield, and you'll understand gold's next move before the headline even explains it to you. So buy, hold, or wait. Here's the honest answer, not the hype answer. Short term, respect the technical risk. Both major chart services covered here are flagging real potential for another pullback, possibly back toward $3,900, even $3,500 in a worst-case scenario for gold. If you're trading short-term, that's not a moment to get aggressive. That's a moment to wait for confirmation. But long-term, the structural case hasn't weakened. It's gotten stronger. A $39 trillion debt load doesn't reverse because of one FOMC minutes release. Central banks buying at a record pace aren't selling next month. Silver's supply deficit isn't closing next quarter. These are multi-year forces, not headline-driven ones, and that's exactly why they're so easy to underestimate in the moment. The move here isn't fear, and it isn't hype-driven FOMO either. It's using near-term weakness as an entry point into a multi-year structural story, not a single trade you're trying to time perfectly. That's the full picture. Gold consolidating on the charts, silver breaking out on its own fundamentals, and a debt-driven debasement story underneath both of them that isn't going away anytime soon, no matter what happens in next week's headlines. If this helped you make sense of what's actually moving these markets, subscribe for the next update. Because with an FOMC minutes release and ongoing Middle East tension both still unresolved, this picture could shift fast, and you'll want to be watching when it does. Drop a comment and let me know. Are you buying this dip, or are you waiting for lower prices first? I'll see you in the next one.